So my name is Eddie Riedl. I'm an accounting professor at Questrom, and thank you all for coming. And so two statements before I get started. I guess I might have renamed this a little bit of like how accountants are going to save the world, which is a kind of provocative title. And in some sense, it actually relates a bit to what Jonathan was just talking about. It's about measurement. And so the specific project has to do with ESG risk disclosures. But let me give you a 30,000-foot view on things. This is the author team. And so Aaliyah is a PhD student. She's doing her dissertation actually on ESG disclosures on state regulations of emissions. And so she's got some really interesting work there, as well as another project. Federico graduated a year ago. He's at UT Dallas, and Estelle does a bunch of work in the ESG space as well. So ESG is, just to make sure we all agree, is environmental, social, and governance related issues. So that's the co-author team. But here's the 30,000 foot. And apologies, a couple in the audience have seen these slides before. We just had a presentation a couple of weeks ago. So apologies for the repeat, but I think this is important. If you think about a timeline, back in the 1920s, we had a situation where we were entering the Great Depression, and we came out with a big regulation called the Financial Statements Act of 33. And that was layered on top of all publicly traded US companies, basically requiring financial statements, which had not been required before then, audited financial statements. In the 1990s, we had a similar occurrence that happened with banking. We had the savings and loan crisis in the United States, and we moved to a model requiring what was called fair value reporting for banks and insurance companies. In the 2000s, we had this massive move called IFRS, which stands for International Financial Reporting Standards, where we basically moved to a model of global financial reporting, which we did not have previously. A common theme across all of those three were a couple of the following things. For one, they affected an incredible amount of companies, thousands of companies and several trillions of dollars worth of capital, and how it got allocated. There's also a massive demand for new types of information to help investors understand how to do allocation decisions. As we started moving towards some of these different areas, what generally emerged is that there were leader firms that evolved that started providing that information on a voluntary basis. And little by little, you had some type of coalescence that occurred where companies, generally grouped by industry, moved into some type of best practice type modeling, but you still had a lot of variability, which again relates directly to what Jonathan just talked about, inconsistency in reporting. And then eventually you get to a point where the regulator steps in and puts on some type of structured regulatory framework. Why am I giving you all this background? In the 2020s, ESG is kind of what we just experienced multiple times in the past. And as accountants, this is actually a movie that we've seen many, many times before. And so the project that we're working on right now is trying to address this broader issue of understanding regulation versus industry best practice, and how do you evolve to a set of standards and best practices that help for information purposes. Let me give you two slides on what the project is, and then I'll be done. Don't worry if you can't read it. On the far left, there's this thing called SASB. SASB stands for the Sustainable Accounting Standards Board. They've since been merged with another entity, but what they basically did for the past 10 years is they came up with a framework for how to group ESG related risks. And what they did, and you see in that blue box I just put out, they came up with 26 different categories, again, as a way to methodically group different types of ESG areas and topics of concern. And in the circle that I just showed, the blue circle, they basically did it on an industry by industry basis. So the circle I'm given as an example is food and beverage. And what SASB concluded is that there are 7 topic areas, 7 ESG areas that they believe are important for the food and beverage industry. And that's what they recommended, that if you're in that industry, you should probably be talking about these are risks, because these are common to companies that are in that industry. In the middle, you could see what I just highlighted. Each topic has key terminology. So the SASB basically went through the practice of trying to define what it refers to. So in this particular example, it's product and service safety and quality. Now, what we did in our project is we went and we grabbed what are called 10K filings. So any publicly traded company in the United States has to file what's called a 10K annually. It's with the Securities and Exchange Commission. Big document with a lot of information. We focused on a particular area called risk disclosures. And what we basically did is we matched up what companies were talking about in their risk disclosures and what SASB is recommending that they be talking about in their risk disclosures. And so what you can see there is that we're able to put things into two groupings, whether they're agreeing or following SASB recommendations or providing disclosures that differ from SASB recommendations. And so here's what we got. One descriptive and some predictive findings. The first thing that we found sitting in that green column, firms actually disclose a lot less than what SASB recommends. They're only on average disclosing 50% of what the SASB recommends. They're also disclosing a heck of a lot of what SASB says is immaterial. So they're actually going above and beyond and doing other topic areas that SASB isn't even recommending. And then what we did is we said, well, why don't we take a look and see what industry is recommending? What is industry best practice suggesting? Many ways to define it. Just for simplicity, for a 6-minute presentation, we used the largest companies and what they were doing as best practice. The big aha is that companies are actually, they're coalescing towards industry best practice quicker than the quasi-regulator of SASB. You can see that in terms of 70% of the ESG topics are common to what the big fish in the ocean are doing, to the industry leaders. And the final big aha that I'll wrap up on, we did a study to basically evaluate what are called left tail outcomes. These are negative outcomes. So things like penalties, incidents, bad ESG occurrences that can happen with a company. And what we found is that in the green box, that third column, it's actually the industry best practice associated disclosures. Those are the ones that tell us more and give us the insights about what's going on. And so what we can conclude from this basically is that that there's an evolution that's occurring. Industry best practice is in the lead, and the regulator is probably going to start to catch up over a period of time, like we've seen many times before. Okay, thank you so much. Tag in, Pete.